Hey everyone, it's Ryan with Stock Investing and Trading 101. Today we're going to be doing an intro to the Greeks on Robinhood. So this video is going to give you an introduction to how to understand what the Greeks represent and the reason that the contract you are buying or selling is priced the way it is. Before we get into today's video, I want to remind everyone to please smash that like button and consider subscribing if you haven't already. It really helps with the YouTube algorithm as well as helping show this video to more people. That way more people can educate themselves and, make more money in the long run, which is what we want. Also, if you want a free stock, check the description. We have a number of different stocks that you can receive. I prefer public. I really like the app, and it gives you the stock very quickly, so check that out. But let's get right into the video. As I mentioned, we are going to talk about the Greeks, the option Greeks, and what they represent. We're also not only going to talk about the Greeks, but we're going to talk about implied volatility and open interest. First, let's start with the Greeks. There are 5 main Greeks. They are delta, gamma, theta, vega, and rho. Let's start with the least important and then go from there. I would say that the least important Greek is the rho. What the rho represents is a change in interest rates and how that will affect the contract price. You can see this one has a rho of minus 0.0010. What this means is that it pretty much isn't going to affect the option price. I wouldn't worry too much about the rho until you have the other ones mastered. The Vega represents volatility, and it represents how the option contract will move in price in relation to volatility. I would say this is the second least important. It is somewhat important, and you should know what it represents. But the main things that I'm looking for when I'm selling an option or buying an option for that matter is the delta and the theta as well as the implied volatility. So let's go to theta. As you can see on this option, it has a theta of minus 0.0553. What this represents is the amount of value the contract will lose each day due to time decay. So theta is synonymous with time decay. So whenever you see theta, just think of time decay. And so pretty much what this minus 0.0565 represents is that every day this particular option will lose $5.65 of value. This fluctuates, as you can see. It just changed a little bit, and it's going to be constantly changing, but it will give you a general idea, and you can pretty much round it to $5 a day. The contract will lose about $5 a day in value, and theta is going to be your best friend if you're selling options and your worst enemy if you are buying options. Obviously, if you're selling an option, you want to take in the most premium that you can receive, and you want the contract to expire worthless or lose value. That way, you can either buy it back for cheaper and keep the difference in profit, or you can just let it expire worthless, and you pretty much get to keep the profit for free. Next, we have delta and gamma. So these are important and can be a little bit confusing. Gamma is directly correlated to the delta. The delta is kind of the leader and the gamma follows. So what the delta represents is for each dollar that the stock moves up, the contract price will go up or down by the amount of the delta. So for example, if Rocket Mortgages, which is our underlying stock, is at $20 per share and our delta is minus 0.24, that means if Rocket Mortgages goes up $1 from $20 to $21, this contract will lose $24 of value, and that's what a negative delta represents. If we bought the call option, the delta would be positive, and that would mean that obviously, if we're buying a call option, we want the stock price to go up. And so a positive delta would represent that we would, in this situation, make $24 if the underlying security moved up $1. So gamma is directly correlated to the delta, and it pretty much represents the amount that the contract will gain or lose in value for each dollar after the first dollar. So you can remember that delta represents the first dollar of move in the underlying security, and the gamma represents the next dollar from there, and these will be changing regularly as well. So those are the option Greeks. We have a very quick intro there. Next, we're going to talk about implied volatility, which is very important and sometimes can get overlooked. So the implied volatility represents essentially how volatile the underlying security is and what the expected move is. And why this is important is because the higher the implied volatility, the more premium is going to be built into the option. If you have an implied volatility right here of 76%, and you have another contract with an implied volatility of 20%, the one with the 76% is going to naturally have a higher premium involved, which means if you're selling it, you're going to collect more premium. If you're buying it, you're going to pay up for the implied volatility. And that's why it's very important when you're selling covered options to check the implied volatility and to theoretically sell options when the implied volatility is high and buy options when the implied volatility is low and you think that the implied volatility, otherwise known as IV, can expand because you can profit from IV expansion or IV going down. Next, you have open interest, which is somewhat important. You want to make sure that your options that you're trading are liquid. And the open interest pretty much represents the number of options that are pretty much out on the market that are sold. So if you have an open interest of like 0 or like 1 to 10, I'd probably avoid that option because it's going to be very difficult to sell that option. So let's go to another example. We're going to go to a less volatile stock. We're going to look at AT&T option. And here we have a call instead of a put that we sold. Okay, so let's look at the Greeks first. As you can see, we have a theta of minus 0.02, which means that this contract is going to be losing about $2 per day of value. And we have a delta of 0.64. So what this represents is that if AT&T goes from $30 to $31, it moves up $1 from the current price. This option is going to gain $64 in value. Last time we had a negative delta because we were short a put. This time we have a positive delta because it is a call option. Call options are going to have a positive delta. And then we have a gamma behind that, which means after the first dollar, so we go from 30 to 31, the contract gains $64. We go from 31 to 32, the contract gains $52. That's how that's done. Implied volatility of 18%. So once again, this is an extremely low implied volatility, which means that if you are selling this option, you are not going to be collecting a whole lot of premium because the underlying isn't expected to move very much. So why would somebody want to buy a contract paying a lot of premium if the market makers and the market is pretty much telling you that it's not going to move very much? You're not going to want to pay a lot in premium expecting a big move if the market's pretty much telling you that it's not going to make a big move. And so that's why implied volatility is important. And that's why, if you think a stock is going to have a big move in the short term, it's good to buy low implied volatility. And that way, if implied volatility goes up, you can profit just from the IV expansion. Not only the IV expansion, but if it goes in your direction, you can profit that way as well. So it's kind of like a 2-for-1 thing right there. And we have open interest of 12,000, which means this is going to be a liquid option and you're going to have minimal issues buying or selling that option. So that's pretty much a brief intro to the option Greeks and, things I like to look for when I'm selling options or buying options, either way. If you have any questions, definitely feel free to drop a comment below in the comment section. Otherwise, I'm interested in hearing what you guys are buying or selling. Let me know what you think in the comments of stocks you're buying, selling, what's undervalued, where you're at in the market. As always, guys, thanks for watching the video. Don't forget, smash that like button, subscribe to the channel if you haven't already, and we'll talk to you guys soon.